Good afternoon, everyone, and welcome to the Global Interdependence Center's 16th Executive Briefing. Today's event is being recorded, and the replay and slides will be available after the event on the GIC website. Since launching this series in mid-March, the GIC has explored many facets of the pandemic, including healthcare policy, China's economy, geopolitics, capital markets, economic forecasting, agricultural trade, and of course, monetary policy with current and former central bankers. Today, we're going to take some time to have a very thoughtful, unbiased critique of central bank actions. And so I'm delighted to introduce our two speakers, Stephen Cecchetti and Paul O'Brien. Professor Cecchetti is the Rosen Family Chair in International Finance at the Brandeis International Business School. Previously, he was economic advisor and head of the Monetary and Economic Department at the Bank for International Settlements, the BIS, in Basel, Switzerland, and received an honorary doctoral in economics from the University of Basel. He has been on the faculty at NYU's Stern School of Business and the Ohio State University, and he also served as Executive Vice President and Director of Research for the Federal Reserve Bank of New York. Dr. Paul O'Brien left the Abu Dhabi Investment Authority, ADIA, at the end of 2018. He worked most recently as the Deputy CIO, helping lead both strategic and tactical asset allocation after starting with ADIA as head of the fixed income strategy. Previously, Paul was a global fixed income portfolio manager at Morgan Stanley Investment Management and head of European economics with JP Morgan. He started his career as economist and then section chief at the Board of Governors of the Federal Reserve System. Paul has a Ph.D. in economics from the University of Minnesota and attended the U.S. Naval Academy and received his undergraduate degree from MIT. Steve and Paul, on behalf of the GIC, we want to welcome you to the executive briefing.
It's great to be here.
Great.
Yes, thank you very much.
So last week, we heard from Charles Evans from the Chicago Fed say the FOMC is going to continue to do whatever it takes to convince the markets that, quote, we're in it to win it. At the same time, President Evans said that some of the Fed's new facilities just aren't that large in the context of the broader economy or of relative to global capital markets. It seems like central banking is never going back to where we began, and that monetary policy is morphing into something new. So Steve, I'm going to ask you to kick off our discussion by framing these tectonic shifts that we are seeing in the Federal Reserve policy. So I'll turn it over to you.
Thanks very much, Bill. It's obviously an honor and a privilege for me to speak. This is my first GIC event, and so thank you very much for having me. I have a few slides that I want to use to highlight the Fed's actions over the past 3 months. Could I have the next slide, please? In any consideration of policy actions, I always find it useful to start with sort of thinking about a framework, and the traditional framework everybody is pretty familiar with, that the central bank's objective is to stabilize the economic and financial system, and to do this they set interest rates, do asset purchases of one kind or another, and make loans. In a crisis, this does tend to shift, and to avoid runs and panics, central banks try to ensure that solvent banks and financial intermediaries can meet withdrawal demands that they might have, and they also try to make sure that markets continue to function and to mitigate the feedback that exists between the real economy and the financial system to keep what is a bad situation from getting worse. They do this by emergency lending, by buying and selling securities, and by lending to potentially lending to the non-financial sector. Now, it's important as I think about it, and I think it's important for everyone to keep in mind that the ultimate source of central bank influence on the financial system is the central bank's balance sheet. So central banks can say whatever they want, but when it comes time to act, it's their balance sheet that matters. So let's have a look at what's happened to the central bank's balance sheet for the Federal Reserve. Can I have the next slide? So starting in this looks at the last at nearly 20 years, and so you can see here that the level in 2007 was less than $1 trillion. Almost all of this was Treasury securities. That's the purple. In March of 2008, Bear Stearns failed. All this other stuff starts to happen. Lehman fails several months later. And suddenly the Fed goes to about $2 trillion. Sorry, that's by the beginning of 2009. And then slowly things in fits and starts, it goes to about $4.5 trillion. Now that was then. If we look at the last few months, you can see the spike to the right-hand side of this picture. On March 11th of this year, the balance sheet totaled $4.3 trillion. As of Wednesday, July 15th, that's a week ago, it was $7 trillion. Now, this is extraordinary. Over 10 weeks, from mid-March to late May, the Fed's balance sheet rose $2.25 trillion. And I think that it's as if from one day to the next, the Fed policymakers were hiking around in the Green Mountains of Vermont and decided that they'd fly to Nepal and scale the Himalayas. We've never really seen anything like this. Now, as you look at that spike, the bulk of the increase is in Treasury securities, $1.7 trillion. I'm amazed by this, that they could even do it. I think it's testament to the Fed's operational capacity. We can discuss the wisdom of this later, but that's the fact. And you can also see in the little table that I have, the other changes that have occurred since March 11th. I should note, and there's a little star there, that the dollar swaps peaked at $449 billion in late May and are way down. Now, I should emphasize that by contrast, even with other central banks, this is extraordinary. The ECB was much later to the party. It's increased its balance sheet by about 70%, which is of this amount. So it's not the same amount. Could I have the next slide, please? If we turn to the liability side of the balance sheet, you can see what's happening here, which is that the bulk of the increase is in two places. It's in reserves and in the government's balance sheet. But first, I just want to note that the purple in this chart is currency. And for everyone who thinks that paper money is disappearing, at least US dollar notes are not disappearing. And in fact, if anything, they're rising at a faster rate than they were before. I think it's a bit mysterious that the federal government's account is at $1.7 trillion, but as of last week, that's where it was. Can I have the next slide? Now, turning to some specifics of the Fed's programs, starting in mid-March, the speed, scope, and size of their actions, I think, has been breathtaking. So on the left-hand side, you see the seven actions that were taken in 2007, 2008, and 2009, offering swap lines to 14 central banks, removing limits on the quantity of Treasury purchases, buying government-guaranteed mortgage-backed securities, creating purchase facilities for commercial paper, supporting money market mutual funds, offering primary dealers loans, and purchasing asset-backed securities. Now, they put those all in place right away. That was done all within a matter of a week, which is pretty striking. So, fortune favors the well-prepared, and they were certainly well-prepared. Now, over the time since then, they generated first very quickly and then slowly adjusted a whole series of additional programs. It's now 9 of them in total, but they're purchasing more municipal bonds, corporate bonds, and they're also supporting lending to non-financial firms. Then finally, they're supporting the Paycheck Protection Program, which I put in a sort of different category because the Paycheck Protection Program is basically a federally guaranteed program. So it's as if they're lending against government securities to banks. So that's quite different from these other programs. Could I have the next slide? Now, I have this slide up because we can classify these programs into the three categories that I had, which is to liquidity to intermediaries, maintaining market function, and ensuring credit availability to the real economy. So they're meeting all of these objectives in one way or another. But what's interesting about this is that the new programs, or at least most of the new programs, all except the asset-backed securities program, are lending to the non-financial sector. This is new. And the question is, how wise is this and what are the implications of it, I think. And I think we need to have something of a conversation about that. Now, could I have the last slide, please? Now, here I have a different sort of summary of these programs. On the left is the initial announcement date, the name of the program, then the maximum size if it is specified, then credit protection if there's credit protection from the Treasury through the Exchange Stabilization Fund and the authorizations of the CARES Act, which, by the way, go to $450 or so billion. So only about half of that is being used here. The balance in each one of these programs as of July 15th, and then my guess at a rough estimate of what the market size is for the market that they're trying to backstop here. Now, what I find interesting about this is that most of the programs remain pretty small. The possible exception is the Paycheck Protection Program, which I put in a separate category. These are small in interesting ways. For instance, the secondary market corporate bond facility, which is the only one that's been operating, has $11.2 billion. But 80% of that is ETFs. They bought a lot of individual bonds, but that's rough going buying those individual bonds, so they haven't done a lot of that. The municipal liquidity facility has purchased one bond, a $1.2 billion issue from the state of Illinois, so you can decide how you feel about that. And the Main Street lending facilities, which they keep adjusting and keep expanding in various ways, has 12 million, that's with an M, million dollars outstanding as of last Thursday afternoon. Now, these could grow, but I think it's interesting to notice how small they are. So I'll stop here with my little introduction and hope that that's fodder for our conversation. Thanks.
That's great, Steve. Thank you very much. And don't go far. We want to have you back for the Q&A. But we'll transition now. We'll ask Paul to come back on screen. Great. So Paul, you and I saw each other last a year ago at the Rocky Mountain Economic Summit, and I know during that conference there was quite a bit of conversation about Fed independence and how long that would continue. Little did we know a pandemic would be coming. Little did we know such extraordinary monetary policy would be implemented. So let me turn it over to you with one simple question. Is the Fed independent today?
My answer is a simple one, Bill. No. The one great framing of the pandemic is that it has accelerated a lot of trends that were playing out anyway. And the end of the era of central bank independence was one of those trends. Now, when I say the Fed is not independent, I don't mean Steve Mnuchin is going to sit in on FOMC meetings and tell the committee what to do. What I mean by the Fed not being independent is the tools of monetary policy are no longer independent. The Fed is basically only able to use what are effectively fiscal policy tools. So it's like two people holding on to the same car steering wheel. They can't be independent. They have to cooperate, and one of them is going to dominate. And in my opinion, in the end, it's going to be the Treasury. Now, three reasons that these tools have become basically blurred or overlapped. One is the Fed now pays interest rates on reserves. Bank reserves basically earn the same interest rate as Treasury bills. And if you think back to your old money and banking class, that used to be the difference between money and bonds. Bonds paid interest, money didn't. And when the Fed shifted the portfolios of the private sector towards or against money, that would affect spending, interest rates, the economy. No longer the case. When the Fed when Fed reserves and Treasury bills, as they do, are basically the same liquidity and pay the same interest, for the Fed to swap one for the other has very little impact on the economy or markets. Second reason, look at quantitative easing. If reserves and Treasury bills are basically perfect substitutes, then quantitative easing is just public debt management. For the Fed to swap reserves for bonds is no different than the Treasury swapping bills for bonds. It's basically the same impact on markets and private portfolios. And then thirdly, look at all these new pandemic programs that Steve just went over. They're largely lending programs, but the federal government has already plenty of lending and loan guarantee programs. The mortgage agencies, student lending, export-import bank. There was absolutely no reason the Fed needed to get involved in all these pandemic lending programs. So what does this mean? What are the implications of the end of the era of central bank independence? First off, it's not necessarily a bad thing. For most of the last several hundred years, we've had central banks, and they have not been independent of governments. Even today, many or most central banks are not independent. People's Bank of China would be the most obvious example, but even the Bank of Japan is not particularly independent. And the purpose of central bank independence was to fight inflation. It really came into being after the 60s and 70s when inflation was a huge problem. But inflation is not a problem right now. So in a sense, central bank independence is solving a problem that we don't really have. Now, if we don't have Fed independence or central bank independence, will we have inflation? In the short run, I don't think so. There's very powerful disinflationary forces in the world. And then look at the Japan example. The Bank of Japan has been cooperating with the Ministry of Finance for years, and Japan has not been able to have inflation. So I wouldn't worry much in the short run, but it is an important change in institutional arrangements. And if you want to think farther into the future, I think it makes sense as an investor or a business person to think about what higher inflation could do to your business or portfolio. A bigger impact, and probably the one that's going to be more important for us of fading of Fed independence, is financial repression. Given the huge levels of public debt, US debt to GDP is now on its way back to where it was at the end of World War II. Low interest rates are essential for the stability of public finances. And the Fed will be under very strong pressure against raising interest rates. In fact, we will probably have a long era of very low interest rates. It will be tougher for the Fed to exit all of its programs, because for the Fed to withdraw support for the economy is going to be potentially pushing against the desires of the federal government and fiscal policy. So given the wide-ranging nature of the Federal Reserve support programs for the economy, getting out of those programs is going to be very, very tough. An additional tough challenge for the Fed is going to be communication. How does the Fed distinguish between interest rate policy, balance sheet policy, all these lending programs? It was confusing enough, I think, for the public when the Fed was just moving the Fed funds rate up and down. Now monetary policy has become so multidimensional and so complicated that it will be very, very difficult for the Fed to communicate what it's trying to achieve. And then finally is just the whole area of Fed reputational risk. The Federal Reserve has a great reputation within the United States, around the world, for integrity, for quality of research, and yes, for independence. And the more the Fed gets involved in designing the fine minutia of lending programs, or whether to lend to this municipality or that municipality, the more the Fed is going to get drawn into political discussions, the more they're going to get second guessed, and the more they risk, I think, as I said, some tarnishing of their reputation. So we're in a new world. It's not necessarily an unusual world historically, but it's a new set of institutional arrangements that we really have to think about. Bill, I don't hear you.
With apologies.
Okay, that's better.
I'm new to this. I haven't done this before. So I was saying, if you'd like to ask a question, we're going to bring Steve back now, but if you'd like to ask a question, just go to the dashboard, pop open the questions tab, enter your question, and that will put it into the queue. Okay, so one of the early questions that came in, and Steve, I'm going to pass this one to you. In responding to the last crisis, 2007, 2008, and 9, and this crisis, the pandemic, have central banks created a moral hazard? In other words, asset market crashes have to be avoided at all costs. Do you agree with that? And is there a moral hazard around creating asset bubbles or even an inflation threat?
Right. I think that the short answer to that, I can be as short as Paul was in answering a question you posed to him, which is yes. They have created a moral hazard problem. I mean, if you do something once, then you can claim that you're not going to do it again, and you can hopefully live up to your claim. But if in a period of 11 years you come along and you do something twice, and these are big things. I mean, this is not small stuff. I think that it's very hard for you to claim that you're not going to do it again. And in this case, I think that, you know, to echo a few of the things that Paul said, I think in this case, they've actually enlarged the scope quite dramatically of what they've done. I mean, Charlie Plosser was arguing, I'm sure both of you remember in 2008 and 9 that the Fed was venturing into fiscal policy territory, and some of us said, yeah, that's probably right, but there was a debate. You could actually argue about it. You can't argue about that anymore. And the reason is that they're backstopping the entire economy now. I mean, they've come along and they said, we're not just going to backstop financial intermediaries and let them make their decisions about lending. Now what we're going to do is we're going to directly backstop non-financial corporations. We're going to directly backstop state and local governments, and we're going to directly backstop small and medium-sized businesses. Now, I don't know what's left. I mean, maybe me or you or something like that. I mean, you know, but there's not a whole lot left here. And so I think the answer now is, how do you get out of this? Yes, it's going to create it's created a put on the Federal Reserve for the entire economy. And that put has value. So yes, that's going to push up the value of almost any risk asset that's out there. And so my big concern is that risk is going to be dramatically mispriced because of the presumption that they're sitting back there ready to come to the rescue at any, you know, sort of anything starts to happen. Volatility rises, we're there. You know, that's bad news if you ask me, but they didn't.
Great, thank you. Paul, do you want to add anything to Steve's remarks?
Well, yeah, I mean, if you think about what the Fed did, Steve's exactly right. They wrote all these puts of ambiguous size and ambiguous strike price. But if a market is trading at 100 and the Fed has an unlimited bid at, say, $95 or $97, well, if I'm Wall Street, I'm buying at 98. Unlimited amounts, because I know my risk is tiny. So that's how it supports asset prices. And the problem, if you're the Fed, is you don't know how much you're supporting asset prices. Is it up $1? Is it up $3? If I weren't there, would it go to 95 or 82? The Fed just doesn't know. And so the only way they're going to find out is by experimenting, by taking some of these programs away. Remember how they spent 3-5 years ago, they were experimenting with reducing excess reserves. They didn't know what would happen is they reverse the balance sheet expansion. They just kept reducing excess reserves a little bit each month. And they found out last year how small was too small. And that's what we're going to do with these lending programs. Things will look okay. The Fed will start dialing them back, and we'll find out.
But just
Great,
if I can add, you know, the critical thing about what happened in September is that they rode to the rescue again. They didn't say, "Oh, you guys work this out," you know. Yeah. and so, you know, so again, are they going to do that for corporate bonds now? Or are they going to do that for municipal bonds?
Great, thank you both. Paul, this one will be for you. The Fed programs have tapered off in terms of usage. In fact, there has been 0 takedowns on the repo facility for almost 2 weeks, and the one-day offering, or 2 weeks in the one-day offering, and none in the longer offerings for some while. And I think Steve showed this on one of his charts, but we've also seen that money supply, in terms of the rate of change in M2, is beginning to roll over, beginning to decelerate. The question is, does this mean with all the new Treasury issuance that dealers are not having inventory financing problems?
Well, there's a couple of different moving parts there. First, let me just take this opportunity to speak against M2 as a useful indicator anymore. And I say this even though my last job at the Fed was actually publishing those numbers. So I know all about M2. And it doesn't matter anymore because, as I said, money and bonds pay the same rate of interest. So there's just huge definitional questions there. But back to this specific question, and it relates a little bit to what I was saying previously, the take-up in the programs are not telling you actually their impact on capital markets because they are backstops, they are out of the money puts. Their value is a function not just of market prices, but also of liquidity and also, more importantly, of implied volatility. So we know that capital market conditions have eased. We know people, at least temporarily, are less worried about the pandemic, less worried about the economy, and so on. So there's less pressure or value being put on these puts that the Fed has written. But that could change in a heartbeat, in a day. And so you've really got to think about those non-linearities. You really got to be very cautious about thinking that programs that are not used means those programs are not needed. They may be needed a lot.
Thank you. Steve, there's a question about the reference you made. It was your slide talking about the liabilities. Where did the 1.7 trillion that miraculously appeared recently, where did that come from? What's your thought?
On the government's account?
That's right.
Well, it's a really good question. I mean, my question is a little bit, the question I'm asking is, why are they issuing debt if they have $1.7 trillion sitting there? Why do they need a buffer that's that large? I mean, you know, I could understand $300 or $400 or $500 billion. I mean, the federal government's big, but it's way more than that. So I'm trying to figure out why, and this is related to some of the things Paul was saying, why the debt manager, the debt management office in the Treasury wants to be issuing debt when they have $1 trillion plus sitting on the Fed's balance sheet that they could just spend. And so I think this really is, if anything, this is, if we needed it, this is further proof to Paul's point that the Fed has turned into a debt manager. Because why would you need to have that? And if you did it any other way, because that stuff, remember, that stuff is paying the interest on excess reserves on the other side of the balance sheet of the Fed. And so I don't know why they're doing that. I wish I did, and I wish they would explain it.
Thank you. So we may go down a rabbit hole on this one, but we're entering modern monetary theory questions now, and it's by far the biggest list of questions that we have. So, Steve, maybe back to you. Is this new monetary policy, this new era of what we're seeing out of the Fed and central banks around the world, is this MMT? And is this the only way for the United States to manage this massive public debt burden?
So, first of all, I don't think I won't claim to understand what MMT is. So, if by MMT what they mean, I will specify something so we have something to talk about, which is that you can issue as much government debt as you want. And especially now because interest rates are low. I think the answer is that people are worrying rightly about the level of debt to GDP. Paul mentioned that we're going back to sort of 1945 levels of debt to GDP. I think people are concerned about that. I think that if it were to go far higher, and I think that there are some forecasts that debt to GDP in the US could easily go to 150%. I mean, we could keep it there and we could survive. There's going to come a point, though, where the market will rebel against this and the risk premium will rise. And at that point, you could easily get into a spiral where you suddenly have to shift to having a very large primary balance in order to convince people that debt is sustainable. I mean, one certainly hopes that the US doesn't turn into an emerging market country, but if you're not careful, in the minds of investors in the markets, you could. So you're going to be fine until one day when you're not. And I don't know when that day is going to come, but the higher the debt to GDP ratio goes, the closer that day comes.
Paul, anything you want to add from an MMT perspective?
Yeah, well, I think when I think of MMT, I think it's neither modern nor monetary nor a theory. It's just Keynesianism brought back. And that's its value. I mean, I think it's a very reasonable proposition to argue that because of the pandemic, on top of demographics, on top of technology, that we do have an excess savings world. We do have a shortage of aggregate demand. There is a role for fiscal policy in basically borrowing those excess savings and deploying them intelligently and appropriately. So that's the irony here, is at the margin, probably we've been too conservative on fiscal policy. Probably we've been too worried about debt to GDP. We've been too worried about inflation. So at the margin, it makes sense for policy to become more stimulative, to borrow more, to spend more, to redistribute more. The problem is human beings are stimulus response animals. The Congress will vote for a higher deficit. Things will go well. They'll get reelected. They'll vote for an even higher deficit. I sort of disagree with Steve. I don't think anyone in Washington is worried about the deficit right now. So when we had massive deficits even before the pandemic came along. Now they're off the charts. They're deficits you haven't seen. And what is the average congressman going to say? Well, 10-year notes are trading below 60 basis points. I can borrow 10-year real money for minus 1%. What's the problem here? And at a certain level, that's a fair comment. But governments like to borrow, congressmen like to spend. We will go too far. Maybe next year, maybe 10 years from now, but this process will be pushed too far because you will have to find out what the speed limit is. And the speed limit will be rising real interest rates, rising inflation, rising nominal interest rates, running on the dollar. Something will call a halt to it. And we will get there almost surely, but we don't know when.
Okay, thank you for that. This question has a premise that the Fed's mandate is tied to the U.S. economy, but the Fed is almost the central bank to the world. So within that context, and maybe Steve, you can take this one. Are there circumstances in which this situation compromises the health of the global economy? And if so, what are the remedies to the negative impacts to the global economy?
So I guess just to make sure that we're all on the same page here, there's a dollar financial system that's not supported by the Fed outside of the U.S. that's probably about the same size no, let me be more clear. Non-U.S. external financial institutions have dollar liabilities that roughly equal those of the U.S. banking system in aggregate size. Sort of numbers like $20 trillion. And we can debate the reasons for this. I think it's pretty clear why the stuff is out there, but it's huge, and it doesn't have direct access to the Fed except through the swap lines. And the swap lines are only available to as I said, 14 central banks, and not all of them are unlimited. So I think that this is a risk for the world, if you ask me. But I'm not sure what the solution is, because the world it's way more efficient to have one numeraire good than it is to have a whole bunch of them. So having one currency run around as basically the anchor for the global financial system makes sense. But I do worry that the Fed has to be willing to support this. The US benefits quite a lot from this, but the US has not always shown a willingness to support it sufficiently, if you ask me. I was actually worried that they would come around and not do it again. I was very pleased to see in March that they did it so quickly and in such size. But it would be great if they could figure out a way to support more than just the banks in the 14 jurisdictions that where they're willing to have the swap lines, and to do it for the rest of the world. But yes, I think it is a risk, and I think it's something that the Fed needs to take seriously, and I think it's something that they need to figure out a way to do rationally.
Thank you. Paul, from a global perspective, did central banks have any other choice than the actions that they've taken, not just this year, but maybe over the last 3 to 5 years? And do you have any sense whether central bank cooperation has been greater? Is there interdependencies between the various central banks?
Central banks did not have a choice. They did not drive the decline in interest rates over the last 30 years. They did not drive the changes in technology and demographics that have caused the savings investment balance to change. So they were managing a situation rather than cause it. And we can debate moral hazard, but I think otherwise, if you want to look at where we were 6 months ago, the United States and most countries had very low unemployment rates and economies were growing. I think no inflation issues. So I think central banks did a pretty good job. As far as cooperation goes, again, I mean, there is, and I think as many of you know, central bankers around the world work together very closely. There's a lot of personal relationships. There's a lot of professional relationships. So there is and will be very strong cooperation on that level. But national economic interests are diverging. Globalization is getting rolled back. So at that level, central banks are going to get pulled with that, I'm afraid, which brings in some really interesting questions about what Steve was just talking about in terms of the role of the dollar, the role of the Fed in the global financial system, and so on. That's another direction of stress and potential challenges.
So let me pull on that thread just a bit, because there's a question here, Steve, regarding your reference to the US dollar as the world's reserve currency. Is there an opportunity or probability that the SDR could replace or become a supplement to the US dollar in terms of reserve currency status?
So I guess, I worked for an institution that does all its accounting in SDR, so I got pretty used to I got pretty used to SDRs, but there aren't very many of such institutions. And the BIS is also about the only institution that if a country had SDR liabilities, they would hedge them back to we would hedge them back to the currency that whatever currency the country wanted. I think the short answer to that is no. And the reason is that the reason that we see so many dollars running around out there is that there's so much dollar invoicing. And unless we saw international trade invoicing in SDR, which I find unlikely, I mean, I guess it's possible, but it seems unlikely. I don't see that, because what is the foundation for the dollar system is the fact that the dollar, the dollar reserve currency system is the fact that there is trade in goods and services and in financial products that is all in dollars. Remember that if you look at the data on FX, that it's still the case that something around 88% of all transactions in FX have the dollar as one leg. So what that means is that regardless of what you want to do in the international markets, what two currencies you want at either end of your transaction, you're going to go through the dollar with very high probability to get there. And so all of those things would have to change. You'd have to go through the SDR. We'd have to be pricing all of our trade and services cross-border in SDR. So and who can, I don't know about you guys, but thinking in SDR is something that takes a lot of practice. As I said, I worked I saw balance sheets and P&Ls every morning in SDR, so I got pretty used to it, but I don't advise it. So I think no.
Great. Paul, question for you. If and when corporate issuers of bonds or commercial paper, or even a muni bond perhaps, that's held by the Fed in one of these programs, if it defaults, what's the Fed do?
Well, as I understand the program, step one is the Fed has a backstop to the Treasury. So what the government basically set up is one of those financial structuring things like a CDO or a CLO, where the Treasury owns the equity and the Fed puts in the debt. So the loss would be charged 100% to the U.S. Treasury. There still could be reputational issues because it was the Fed that decided to buy that bond. So the Fed could easily be criticized for that decision. By the way, this raises a really interesting issue about a lot of these Fed programs. I don't know if you saw, but there were press reports last week about how the Fed was pushing the Treasury to be more liberal with the Main Street lending program terms. Well, if you think about it, the Fed doesn't own the credit risk. The Fed's actually trying to manage the economy and support employment. That's part of their job. The Treasury owns the default risk. So it's an interesting dimension of disagreement to watch between the Fed and Treasury, because they do have different institutional goals, and they do have different political situations.
Can I make a quick comment about that? First of all, I just was looking at my table, which is in one of the charts. On the corporate bond programs, the backstop's $75 billion. So the first $75 billion in defaults, as a legal matter, as an accounting matter, I should say, legal. This is all on the consolidated balance sheet of the government. Who cares? But as an accounting matter, that belongs to the Treasury, and it is in an SPV, so. It's like this is an off-balance sheet activity from the point of view of the Fed. As Paul said, it's reputational damage, except for in the case of the corporate bonds, they've largely contracted this out to people like BlackRock, and so it's not clear whose reputation gets hurt and where or when. CP is a little bit different. The backstop, though, is still $10 billion, and to have $10 billion of CP, given the size, given the fact that they rarely hold more than $10 billion, defaulting seems like that's going to be pretty tough. The interesting thing about the Main Street program, I think, is that the Fed was trying to structure the Main Street program to reduce the adverse selection problems that seem to exist when you have very, very stringent criteria. So if you have very high interest rates and very high origination fees, which is what the existing programs tend to have, the only people that are going to try to go there are the ones that are desperate. And the Fed was actually trying to reduce the desperation and thereby it's this very strange sort of it seems upside down, but if you reduce the price, you actually could improve the quality of the borrowers. And that's what the Fed was trying to do. And they largely failed. And I think that one of the reasons that we're seeing almost no take up in the Main Street program is because of adverse selection. There's not much desperation. There is, as Paul put it, an out of the money put. This one seems to be pretty far out of the money. And let's just hope, at least I hope, that we never get to the point where there's take up in this program. Because if we do, that's going to be I mean, boy, head for the hills. That's going to be really bad news.
Okay, thank you. This question is going to go to both of you. So it starts with, shouldn't today's T-bill yields be interpreted as a signal that the future is disinflationary as opposed to inflationary? Do you agree with that, or has the market lost its signaling function because of what the Fed's doing? Paul, what do you think?
There are very strong disinflationary forces at work right now. At an unemployment rate of 10, 11%, there's a huge amount of slack in the labor market. You've got corporate bankruptcies going on. You have demand has crashed in a number of important sectors of the economy, like air travel, restaurants, some tourism. So I think it would be very difficult to imagine inflation rising in any meaningful way over the next 12, 18, 24 months. And that certainly means, and the Fed is basically committed to keeping policy rates at near zero through that time. So I don't see that as a mispricing. The more interesting potential mispricing is the idea that 10-year notes at 60 basis points are fair, or that a 10-year real interest rate, which is getting pretty close to -1%, that is sustainable. And I think markets have just as much trouble as economists looking ahead more than 12 to 18 months. So I think, but the market is making a very strong statement of low inflation, not just this year, but I think the 30-year break even is 1.5%. That's a very strong statement.
Okay. Steve, you want to add anything?
I mean, I agree with that. I think that the troubling part of this is you've got a real interest rate of -1 out pretty far, as Paul said, or something like that. But the break-even inflation rates are still at levels that are fairly reasonable. Again, if you were a policymaker and you wanted 2%, you wouldn't be ecstatic about 1.5. But in an environment like this, if somebody tells you can get 1.5% inflation, you'd say you'd take it. So that's not what I would call hugely disinflationary, at least not yet. But the question is, what about that one? What about those negative long run real interest rates? That's a bad signal for the economy as a whole, and I think it suggests that we're in for a period of pretty significant adjustment. I've compared this in some discussions. We're all old enough to remember the late 1970s. And in the late 1970s, you had to have a lot of adjustment because your capital stock basically had the wrong structure for at the time it was energy prices. But right now, I think our capital stock has the wrong structure for how it is that business is going to be organized and what demand's going to look like 5 years out. I don't see a lot of the stuff recovering. That we're just going to behave differently, even if we get a vaccine, in the next 6 months.
Steve, I'll give this question to you. why aren't they letting it be worked out as opposed to the Fed coming in and riding to the rescue? Why don't they just let the market work its way out the way it used to happen in the 70s and 80s?
Well, I'm not sure it happened quite to the same degree that it might have to happen this time. I think that what I would say, and I think this is really a follow-on to Paul's original comments, is that that if the Congress wants to support all of these markets and wants to support all of these borrowers, you know, look, the government does a lot of things I don't like. It does a lot of things I do like. But if they were to pass legislation that said, you know, we want federal programs that do this stuff, I would say, well, I don't have to like it, but you know, we elect you, that's what you do. The problem here is that they're asking an independent institution to do it. If the Treasury were doing this, we would be having a slightly different conversation. So I mean, I wish that people complain about the Treasury not being competent to do this, at least not to set it up. So my answer is, well, write in the legislation that the Federal Reserve agrees to do 6 months worth of setup and then hand it off to the Treasury. So I think that that some of this politically would be difficult. They're just not going to allow all of this stuff to fail. The politicians aren't. And so it's a question of how it's saved and for how long, not whether it happens. And there I would just say that we're doing it the wrong way, at least for my taste.
Okay, Paul, I'm going to ask you to put your CIO hat on. And from an asset allocation perspective, kind of two questions here. Which is more overvalued, treasuries or equities? General question. And then what would be a catalyst to see the equity market revert from, you know, what's been a tremendous V and recovery since the pandemic panic that we saw back in March?
I mean, both treasuries and equities are expensive. I think equities are less expensive, thinking in long run terms. In long run terms, your returns are your yield, dividend yield, earnings yield, plus the change in the yield, plus any changes in valuation. Well, if you think about treasuries, you have a paltry yield, and that yield is never going to grow because the coupon is fixed. In the equity market, you've got actually a higher yield than the treasury market. And plus, those yields will grow. They may grow more slowly. Dividends and earnings may not grow as fast as they used to, but they will grow. And yes, valuations are high, but they're not crazy high. And if valuations have to fall and you average that over 10, 20 years, the impact on returns will be offset by the yield and the growth in earnings. So if I want to grow capital over the next 20, 30 years, the equity market is far more attractive. But you just have to get yourself comfortable with much lower returns than you've gotten in your investing career. If the real interest rate is minus 1% right now, which it is, and equity risk premium turns out to be 4%, which is the long run average and would be a pretty nice outcome, well, a balanced portfolio is going to get a real return of 2 or 3%. Real, add whatever inflation rate you want. So where is the equity market at risk? Well, it's at risk on the growth side. Again, we're assuming that earnings bounce back. I mean, the market, if you ask the market what it's thinking, it will tell you. It thinks earnings next year will bounce back at least to where they were in 2019. And then those earnings will more or less continue to grow at the growth rate you would have expected back in 2019. And so, to me, I see two risks to that assumption or that forecast. One is that the economy does fall back into recession for any number of reasons, financial stress or whatever. Or two, and this might be a little bit more subtle, but the government might start taking some more of those earnings back through taxes. and that's going to harm asset prices in the long run. But none of that changes the fact that if you want to grow and preserve capital and you have a long-term horizon, the equity market is far better priced right now, a far better deal, I think, than treasuries.
Thank you for that. Steve, an easy one for you. What's your view on Judy Shelton's nomination to the Board of Governors?
Well, I guess I wrote a post at www.moneyandbanking.com that said just say no, and I guess I'll hold to that. I think that let's just. I would ask anyone who's in favor of Judy Shelton should ask themselves how they would feel if a gold standard had been in place in January or March of this year, and if, because gold prices I believe were rising at the time, what it is that the Fed would have done under those circumstances, and I think then the question answers itself.
Great. All right, we've got time for 2 more questions. And this will go to both of you. Paul, if you had one silver bullet to address all problems with economic growth, excessive debt, what's the one policy relief or policy prescription that you would encourage all policymakers to focus on? Monetary, fiscal, you pick it.
I don't think there is a magic bullet, Bill. In fact, I think you really need to think about balance. I think what you have is a problem where you need to maintain growth and you need to allocate the costs of maintaining growth equitably across society. That's the problem with inflation. It allocates the cost, but very indiscriminately. That's the problem that didn't Einstein say once that for every complicated problem, there's a simple answer that's wrong? I think we've got a very complicated problem, and the solution is going to be complicated.
So I guess I'll answer that. I'll once again change the question so that I have an answer, and that is, what's the number one thing that I would encourage people to do? And I think the number one thing, what we need desperately, and this is the time for it, is infrastructure investment. We need infrastructure investment of all kinds. We need investment in basic science. We need investment in roads and bridges. We need investment in education. We need public investment in public goods. And I hope that people use some of the borrowing ability that they have right now to shift some of the spending into that public investment, because this is sort of the perfect time for it. But as Paul said, it's not a silver bullet. It's not going to solve a lot of problems, but what it could do is it could help build a foundation so that you at least have a chance of having long run improvements in growth.
Great, thank you. And the very final question, it's our favorite we like to ask, what's the one economic indicator that you are watching and recommend that everyone pay attention to? Paul, you want to go first?
Sure. I mean, I've always liked weekly jobless claims. They're very high frequency, very closely tied to what's going on in the real economy. They did tick up this morning, which I think is significant. So if you want to watch any one thing, I would watch the claims data.
I would agree with that. I might open the entire, instead of just looking at the headline, I might open the whole release and look at the total number of people that are currently receiving unemployment benefits, because that includes all the ones who are receiving it for all of the programs that are one-off that came out of the CARES Act, because the number then is closer to, it's over 30 million rather than less than 20 million, which is the number of continuing claims in the state programs. But I think Paul's exactly right, that if you're going to look at one thing right now, the answer is look at the unemployment.
Great. Well, that's it for us. Steve and Paul, thank you both for being here, for sharing your thoughts and insights with our GIC community. It's just really fantastic, and enjoyed the conversation with you. I wish you both a wonderful rest of the summer. We hope to see you in person very soon. Until then, thank you, and both of you, please be safe this summer.
Thanks
Thank you,
very
Bill.
much. Thank you,
So
Bill.
audience, the executive briefing is going on August recess to allow our staff a very well-deserved break and to recharge. And I want to say thank you to Jill Fornito and Colleen Murphy, who do all the work to make this series a really great program and for putting this together. We will be back in the second half of September through the end of the year with programs on China, climate change, artificial intelligence, healthcare policy, the election, and of course, monetary policy. So please keep an eye out for your invitations in the email. As a reminder, all past episodes of the executive briefing are available on replay on the GIC website. To find the replays or to explore more about GIC membership or to donate, please go to the GIC website at www.interdependence.org.